What if I told you that the Australian dollar that's been struggling at multi-year lows is on the verge of a major turnaround in 2025? I know, it sounds counterintuitive. After all, everyone's talking about stagflation, rate cuts, and global uncertainty. The headlines are full of doom, slowing global growth, persistent inflation, and rising geopolitical risk. But what if the market is missing the bigger picture? Stick around, because I'm going to walk you through the lesser-known forces that are quietly lining up, and they all point toward one thing: a potential surge in the Aussie dollar. Before we jump in, just a quick reminder: this video is for educational purposes only. I am not a financial advisor. What you're about to hear is my personal view, based on the same macro process I use in my own swing trades. As always, do your own research. Welcome to Markets and Global Trends. If you're returning, it's great to have you back. And if you're new here, this is where I break down macro-driven trade ideas, not just charts, but the story behind the moves. Today's focus: the Australian dollar and a trade setup that's caught my attention: long Aussie dollar Swiss franc. I'll walk you through my thinking, the macro backdrop, the tailwinds, the risks, and why this isn't just about trading a currency, but understanding a narrative that's unfolding in real time. To understand where Aussie dollar might be headed, you need to understand what it is. The Australian dollar isn't just a currency, it's a barometer for global risk appetite. It's tied to commodities. It's tethered to China. It's a mood ring for the world economy. Historically, Aussie dollar has been a favorite in times of reflation. Think back to 2009, after the global financial crisis. Aussie dollar US dollar surged over 40% as stimulus in China and a commodity boom lifted global demand. And in 2020, post-COVID, we saw something similar. Aussie dollar rallied hard on vaccine optimism and the China rebound. But let's not forget the 2023 commodity supercycle narrative. Remember how energy prices surged post-Russia-Ukraine war? Even as oil cooled, demand for critical minerals like lithium, copper, and rare earths exploded, and Australia happens to be a key global supplier. Fast forward to 2025, and we are seeing a fresh wave of demand from the EV and green energy sectors. Australian lithium exports have quietly surged again, with Tesla and Chinese automakers signing long-term contracts with Aussie producers. That's not just a trade story, it's a currency tailwind. Commodities don't just drive GDP, they drive capital flows, and that capital flows through the Aussie dollar. It's one of the big three commodity currencies alongside the Canadian dollar and the New Zealand dollar. When these currencies move, they often signal shifts in investor sentiment. And right now, subtle but powerful currents are forming beneath the surface. In fact, capital allocation trends are shifting in real time. Institutional investors are beginning to rotate out of crowded tech trades and into underpriced cyclical themes like commodities and, by extension, commodity currencies. Hedge funds have started building long exposure in Aussie dollar futures, according to the latest CFTC positioning data. It's early, but these flows often mark the beginning of macro trend reversals. Let's zoom in on China, because if one country pulls the strings on Aussie dollar, it's them. China is Australia's largest export market. We're talking iron ore, coal, LNG, the lifeblood of Australia's trade surplus. When China grows, Australia prospers. In 2023, the Chinese recovery fell flat. Zero COVID scars, a real estate crisis, and declining consumer confidence. That crushed sentiment around Aussie dollar. But 2025, the tide is turning. Beijing is back on the stimulus train. The National People's Congress just unveiled a massive fiscal package, echoing moves we last saw in 2016, the so-called old-school stimulus playbook. Infrastructure projects, consumer vouchers, easier credit. The Chinese government is fighting to revive growth, and when China builds, Australia sells. And in 2025, China's plans are not just about old-school infrastructure. There's a push to decarbonize steel production, build battery supply chains, and expand renewable energy grids, all of which require massive inputs from Australia. It's a new kind of industrial policy, one that plays right into Australia's export strengths. Plus, China is rolling out a digital yuan expansion pilot in 5 provinces, and analysts believe that could reshape import financing. If successful, it may further increase cross-border trade flows in the Asia-Pacific region, with Aussie dollar as a key intermediary. Let's widen the lens. Despite all the noise, inflation, rate cuts, geopolitical flare-ups, global equities have remained remarkably resilient. Tech has surged. Semiconductors are on fire. AI adoption is driving new capex cycles. Just last quarter, the Nasdaq touched new all-time highs. That resilience is key because when global markets rally, risk on currencies like Aussie dollar catch a bid. And here's another factor: AI. Not the tech, the capital expenditure. From Nvidia to Microsoft, major companies are pouring billions into infrastructure. That's boosting demand for semiconductors, copper, and rare earth metals, many of which come from Australia. Global investment into AI infrastructure is driving a resource demand boom that isn't fully priced in yet. It's not just a tech story, it's a commodity story too. It's the classic rotation out of safe havens like the Swiss franc and Japanese yen into higher-yielding plays. Aussie dollar, with its positive real yield and commodity exposure, starts to look attractive again. Here's a twist that most retail traders miss: the Reserve Bank of Australia (RBA) has been unusually cautious. While the Fed and ECB raced into rate cut mode, the RBA held back. In 2024, no cut. In early 2025, just a token move. That signals something. Either the domestic economy is more resilient, or inflation is stickier, both of which support the Aussie. Market participants respect central banks that stay calm under pressure. Think about it: while the ECB is debating recession and the Fed is trying to balance labor market cooling, the RBA's silence speaks volumes. And it's not just silence, it's resilience. Australia's 2024 GDP growth surprised to the upside, coming in at 2.4% annualized versus the RBA's forecast of 1.9%. Unemployment remains historically low, and consumer spending, while moderating, has held up better than most developed economies. That underlying strength has given the RBA the room to wait, and markets are now adjusting to a slower easing path. That repricing is already showing up in Aussie bond yields and interest rate differentials, both key drivers of currency valuation. That divergence is helping create a relative strength story in Aussie dollar, especially against low-yielding currencies like the Swiss franc, or in short CHF. Let's come back to the US dollar. In 2022 and 2023, the dollar was king. Hawkish Fed policy, soaring yields, and a risk-off backdrop made DXY unstoppable. But 2025 is a new chapter. The Fed is softening its tone. The bond market is pricing in 3 rate cuts this year. DXY is drifting lower. And in FX, when the dollar loses altitude, something else must rise. The Aussie dollar-US dollar pair is one of the most sensitive to these shifts. And then there's the wild card: President Trump. He's back in the White House. Love him or hate him, markets remember his first term, a preference for a weaker dollar, constant pressure on the Fed, and trade policy that moved currencies. His rhetoric alone in 2018 to 2019 triggered massive USD sell-offs. Now in 2025, his team is floating ideas around export competitiveness and currency alignment again. Traders are listening. And don't underestimate how a weaker USD affects capital markets globally. If Trump leans on the Fed and the dollar weakens materially, US real yields could compress, sending global capital hunting for yield elsewhere. That elsewhere often includes commodity currencies with positive carry. It's a classic macro rotation. And here's a local story that flew under the radar: Australia's new pre-election budget. In a surprise fiscal move, the government announced $17 billion in tax cuts and energy rebates. That's a big injection of domestic demand. While most headlines focused on the political angle, the market impact is quietly bullish. Fiscal support, even short-term, can lift GDP expectations, improve business sentiment, and put a bid under the Aussie. Even more interesting, the budget included incentives for domestic manufacturing and mining technology. This could accelerate Australia's role in critical mineral processing, giving Aussie dollar a structural tailwind. If this policy is sustained post-election, the Aussie may gain a new identity, not just a risk barometer, but a value-added export currency. Now let's talk about risks. No trade setup is bulletproof. China risk: if the Chinese recovery stumbles, say, another property crisis flare-up or deflation shock, Aussie dollar takes a hit. Trade War 2.0, Trump's policies are unpredictable. If he re-escalates tariffs on China, Australia, being China-dependent, becomes collateral damage. Global recession: if stagflation persists or growth collapses, Aussie dollar, as a classic risk-on currency, is the first to get dumped. Mark your calendar, April 2nd. That's when the US is expected to unveil its new tariff review. If it's hawkish, markets could go risk-off fast. Aussie dollar would feel that pressure. And keep in mind, April is also when major Q1 earnings from US tech giants hit. If those earnings disappoint and lead to broader market risk-off, we could see temporary weakness in Aussie dollar. But if results remain strong and capital keeps rotating into growth, Aussie dollar stands to benefit again. There's also the next OPEC Plus meeting in late April. Energy markets could become volatile again. Higher oil generally supports the Aussie dollar through its impact on inflation expectations and commodity flows. So, here's my trade: long Aussie dollar Swiss franc, not Aussie dollar US dollar. Why? Because I'm a swing trader. I like holding positions over days, sometimes weeks. With Aussie dollar Swiss franc, I get positive swap, meaning I get paid to hold the position. It trends cleanly, especially when the narrative is in Aussie dollar's favor and CHF weakens during equity rallies. And crucially, it sidesteps some of the headline noise from the US dollar story. It's also worth noting, CHF has been under quiet pressure. The Swiss National Bank surprised markets with a dovish tilt in March 2025, aiming to weaken the franc to support export competitiveness. That adds further fuel to the Aussie dollar Swiss franc trade. A falling CHF combined with a rising Aussie dollar can create a powerful momentum setup. That's my macro take. Now I want to hear yours. Do you see the Aussie dollar turning the corner? Will China and Trump shape the next leg of this rally? Or are the risks too big to ignore? Drop your thoughts in the comments. If you enjoyed this breakdown, hit like, subscribe, and share it with someone who trades FX or just loves a good macro narrative. This is Markets and Global Trends, and this is why we trade stories, not just signals.